Welcome to the deep dive, where we cut through the noise to get to the core insights you need. Ever wonder what auditors really do beyond, the spreadsheets?
Oh, absolutely. There's a whole world there.
Yeah, a vital, intricate world of communication and reporting that underpins a company's financial health. And honestly, it's far more nuanced than you might realize.
Definitely. And today, we're taking that deep dive into communication and reporting in an integrated audit.
Hmm.
When we talk about an integrated audit, well, we're not just looking at a company's financial statements.
Right.
We're also assessing its internal controls,
Mm-hmm.
the systems and safeguards it has in place to make sure everything is accurate and reliable.
Exactly. Our mission today is to decode the specific ways auditors share their findings and formally report on them. Whether those findings are good news, confirmations of strong controls, or maybe signals of serious issues, we'll be pulling practical insights from our sources to give you a clear, detailed, and hopefully easy to understand picture.
And it matters, right? Why should you care?
Well, because understanding these processes unveils those hidden layers of trust and transparency in financial reporting. It shows how auditors really act as navigators, guiding stakeholders through some pretty complex information.
Nicely put. So let's unpack this.
Okay, so to really peel back these layers of audit communication, we probably need a solid foundation first. What exactly is an integrated audit?
Yeah, good starting point. Basically, an integrated audit is a comprehensive examination. It marries two crucial components.
Okay.
First, the traditional audit of a company's financial statements, and second, a concurrent audit of the effectiveness of its internal control over financial reporting, or ICFR.
ICFR, right.
Think of it like ensuring both the final numbers and let's say, the plumbing system that produces those numbers are sound. Both need checking.
Got it. So as auditors are digging into these systems, they're looking for problems, potential issues.
Yeah.
And these problems, even ones that seem minor, they have very specific names, specific classifications. Our sources break them down into three key levels. Let's start with the most basic one, a control deficiency. What does that mean?
Okay, a control deficiency is essentially a flaw in a company's internal safeguards. The material we looked at defines it as when the design or operation of a control does not allow management or employees to prevent or detect and correct misstatements on a timely basis.
Okay, so timely basis is key there.
It is. It's like finding maybe a loose screw on a complex machine. It might not cause a breakdown right now, but it signals something isn't perfectly calibrated. And that's important to know.
So a potential weak spot, a little crack in the foundation maybe.
Kinda.
Now, stepping up in severity, we have a significant deficiency. How's that different?
Right, so a significant deficiency is definitely more serious. Our sources describe it as a deficiency or a combination of deficiencies in internal control that is less severe than a material weakness, yet important enough to merit attention by those charged with governance.
Important enough to merit attention.
Oh, okay.
Yeah.
The key distinction there is its importance. It's a flaw that the company's highest oversight bodies, like the board or the audit committee, they really need to know about it and address it, even if it doesn't immediately spell disaster.
Okay, that clarifies it. So not just a small crack, but something that genuinely needs leadership attention.
Precisely.
And then at the top of the scale, the big one, material weakness. This sounds pretty serious.
It absolutely is. A material weakness is the most critical finding an auditor can make regarding internal controls. It's defined as a deficiency or a combination of deficiencies in internal control, such that there is a reasonable possibility that a material misstatement of the entity's financial statements will not be prevented or detected and corrected on a timely basis.
Reasonable possibility of a material misstatement. That's the key phrase.
That's the absolute heart of it. It means there's a significant chance, not just a remote one, that a large, important error in the financial statements could happen and not be caught by the company's own controls. It's like finding a gaping hole in the company's financial safety net.
That analogy really helps. So, okay, putting these D words together quickly. You
Mhm.
say expense approvals. A control deficiency might be the form isn't clear on who signs off.
Minor confusion, maybe.
A significant deficiency could be, I don't know, only one person approves huge expenses, no second look, needs fixing, right?
Right, needs attention from the top.
But a material weakness, that's like no formal approval process at all. Someone could potentially walk away with millions because the system's broken.
Exactly. That reasonable possibility of a major error is what keeps auditors focused.
Okay. So once an auditor finds one of these issues from a minor deficiency up to a material weakness, who gets told? And how? It sounds like the rules vary depending on the company type.
You're absolutely right. The communication process differs quite a bit depending on whether the company is a non-issuer, which basically means a private company,
Okay.
or an issuer, which is a public company listed on a stock exchange. Different audiences, different timings sometimes.
Let's start with non-issuers then, the private companies. What are the rules there? Seems like material weaknesses and significant deficiencies have specific requirements.
They do. Very specific. For non-issuers, auditors have to communicate all identified significant deficiencies and material weaknesses. And it has to be in writing.
In writing, okay. Who gets that letter?
It goes to both management and those charged with governance. That term covers whoever's overseeing the company. Could be the board of directors, partners, maybe even owners in a smaller business.
And when does this happen?
Typically, this written communication needs to happen by the report release date. That's the date the audit report is issued. And interestingly, even if these issues were already talked about, maybe even fixed during the audit,
They still have to be in that formal letter.
yep, still have to be formally documented in writing, no exceptions. Auditors can communicate earlier, of course, maybe verbally, but the written communication is mandatory.
What about the smaller stuff, the less severe control deficiencies?
Mhm.
Do they need a formal write-up too?
Yes, they do. But the timeline is a bit different. All control deficiencies, even the minor ones, must be communicated in writing, but just to management.
Just management.
Right. And this needs to happen no later than 60 days following the report release date. So a bit more time there.
Okay.
But importantly, those charged with governance, the board or equivalent, must be informed that this communication to management took place. So they know management got the memo on the smaller issues too.
It really sounds like the auditor has a big responsibility to flag problems, even right at the top. What if the oversight body itself, like the audit committee, isn't doing its job effectively?
That's a really critical check and balance in the system. If the auditor concludes that the oversight by the audit committee or whoever is supposed to be overseeing financial reporting is ineffective,
Yeah.
they must communicate that conclusion in writing directly to the full board of directors. It's a serious finding about a breakdown in governance.
Wow. Okay. Now, a really important point from our sources about the auditor's scope for these non-issuers. Auditors aren't actually required to search for every single minor deficiency, right? Only the big ones.
That's exactly right. They don't have to hunt for every deficiency less severe than a material weakness.
But if they happen to find one during their work,
Then they do have to report it following the rules we just discussed. Any deficiency identified gets reported.
okay. And this explains why auditors can't issue certain kinds of statements.
Precisely. This is a common misunderstanding. An audit gives reasonable assurance, not absolute assurance. So an auditor should never issue a report saying something like, no such deficiencies were noted.
Because they weren't looking for all of them.
Exactly. The audit isn't designed to find every single minor flaw. Similarly, they can't state no material weaknesses were identified if that's the situation. They just wouldn't mention any if none were found. It's about being precise and not overstating the scope of the audit.
Makes sense. So that covers private companies. What about public companies, the issuers? The structure seems similar, but with some key differences, especially who gets the message and when.
Yet for public companies, the rules are generally aligned but often stricter, mainly due to SEC regulations and PCAOB standards. The recipients are specifically management and the audit committee.
Okay, audit committee is key here.
Very key. All material weaknesses found must be communicated in writing to both management and the audit committee prior to the issuance of the auditor's report. That timing is critical.
Before the report goes public.
Exactly. Significant deficiencies also go to the audit committee in writing. And just like with non-issuers, all the lesser deficiencies are communicated in writing to management.
And the audit committee gets notified about that communication.
Correct. The audit committee has to be informed that management received that communication.
And the ineffective audit committee oversight, same rule, if the auditors think the committee isn't effective.
Identical rule. If the auditor concludes the audit committee's oversight is ineffective, that conclusion goes in writing to the full board of directors.
And the scope limitation reminder.
Same principle applies. Auditors aren't obligated to search for all control or significant deficiencies, but any they do stumble upon must be communicated. And again, they cannot state that no such deficiencies were noted.
Our sources even had a sample communication letter for non-issuers. It really shows how formal these internal private communications are, addressed to management and the governance folks.
Yeah, those samples are helpful. The letter clearly states the purpose of the audit, the integrated audit. It emphasizes the auditor's responsibility is to get reasonable assurance. High assurance, but crucially, not an absolute guarantee.
Right, not a guarantee.
It defines each type of deficiency found, explains their potential impact. It's really a confidential heads up, not meant for public eyes.
And it usually has that important disclaimer, right?
Yeah,
Something about the communication being intended solely for the information and use of management and others within the organization. Restricted use.
exactly. It underscores that it's a vital internal advisory. It's from the auditor to the company's leadership, designed to prompt necessary action and internal fixes.
Okay, so we've covered how auditors communicate privately, internally. But all this hard work, all these findings, eventually lead to a very public statement, the auditor's report itself.
Right. This is where the findings hit the public domain, especially for issuers. Auditors have to report on both the company's financial statements and its internal control over financial reporting, the ICFR.
And they have a choice in how they present this, separate reports or combined.
They do. Companies and their auditors can choose. They can issue two distinct reports, one for financials, one for internal control, or they can issue one combined report covering both.
If they go the separate route, do the reports just stand alone?
Not quite. If they issue separate reports, each report must include a paragraph, usually in the opinion section, or a dedicated other matter paragraph that references the other report and states the type of opinion given in that other report.
Ah, so they're linked, cross-referenced.
Exactly. It ensures anyone reading one report knows the other one exists and what its conclusion was. Completeness.
And the combined report just puts it all together.
Pretty much. It's a single document, usually starting with the opinion on financial statements, followed by the opinion on internal control, and then the basis sections for both. It's often seen as more efficient.
Okay, let's break down the structure of these public reports. Using maybe a non-issuer sample from our sources as a guide, what are the key sections we'd see?
Sure. There are several crucial parts. First up, usually is the opinion section. This is where the auditor gives their verdict. For internal control, it might say something like, in our opinion, ABC Company maintained in all material respects effective internal control over financial reporting.
The bottom line right there.
Exactly. Then you have the basis for opinion section. This explains how the auditor reached that opinion. It'll state the audit was done according to standards, GAS for non-issuers, GAS and PCAOB standards for issuers. It mentions obtaining sufficient appropriate evidence.
Okay, opinion, then the basis. What's next?
Next, you'll typically find the responsibilities of management section. This clearly lays out that management is responsible for designing, implementing, maintaining effective ICFR, and also for assessing its effectiveness themselves.
Puts the onus on management first.
It does, which then leads logically into the auditor's responsibility section. This outlines the auditor's job. Get reasonable assurance about whether effective ICFR was maintained. And it usually reiterates that crucial point. Reasonable assurance is high assurance, but it's not absolute assurance, not a guarantee.
Important distinction.
Very. This section also details some audit procedures exercising professional judgment, skepticism, understanding ICFR, assessing risks, testing controls.
Right, and then there's this paragraph that our sources flagged as really important, almost like a passkey, the inherent limitations paragraph. Why is this section so critical?
Ah, yes. This paragraph isn't just boilerplate, it's fundamental. It's the auditor managing expectations for anyone reading the report. It reminds them that internal control, no matter how well designed and operated.
It's not perfect.
Exactly. It's a process affected by those charged with governance, management, and other personnel. It's designed for reasonable assurance, not absolute certainty. It's a profession essentially saying, look, systems rely on people, and people aren't perfect, and circumstances change.
So what kinds of limitations does it typically mention? What makes even good controls imperfect?
Our sources usually list a few common ones.
Yeah.
The potential for just simple human error or mistakes.
Okay.
The risk that people might collude to get around controls.
Sneaky.
The possibility that management itself might override controls for improper purposes.
Uh-oh.
And just the fact that conditions can change or compliance with policies might deteriorate over time. All these mean even strong controls might not always prevent or detect every single misstatement. It's a vital reality check.
Crucial context. And finally, the report date itself. Anything special about that date?
Yes, very specific rules here. The report on internal control should be dated no earlier than the date the auditor has gathered sufficient appropriate audit evidence to support their opinion.
Makes sense. Can't sign off before you have the proof.
Right. And crucially, that date must be the same as the date of the financial statement audit report. They have to coincide. They're issued together as part of that integrated process.
Okay, we've looked at what auditors are searching for, how they talk internally, and what a clean public report looks like. But what about when things aren't clean? Specifically, what's the impact if they find a material weakness?
That's a major finding. If an auditor identifies one or more material weaknesses in internal control, it always results in an adverse opinion on internal control.
Adverse. That sounds bad.
It is. It's the auditor's most serious type of opinion for ICFR. It's a clear declaration that, in the auditor's professional judgment, the company's internal control system is not effective.
A very strong statement. Our sources had sample language for a non-issuer, something like, because of the effect of the material weakness described in the basis for adverse opinion section, ABC Company has not maintained effective internal control over financial reporting.
Exactly that kind of language. It's direct, unambiguous. The controls failed the test, essentially.
And there's a specific section explaining why.
Yes, that adverse opinion is immediately followed by a dedicated basis for adverse opinion section. This is where the material weakness itself is defined and described in detail. Often, this section will reference management's own assessment if they've also identified and reported the weakness.
Okay, but what if management doesn't report it? Or maybe tries to downplay in their own required report on internal controls? What's the auditor's duty then?
That's a really important scenario. The auditor has a critical, professional, and ethical duty here. If management's report on internal control fails to include a material weakness the auditor found, or if it doesn't present it fairly, the auditor's report must explicitly state that. It needs to describe the material weakness that management omitted or misrepresented. Full transparency is paramount.
Then they tell the board too.
Absolutely. This situation also requires written communication to those charged with governance, making sure the board knows about management's omission or misrepresentation.
So this adverse opinion on internal control, does it automatically mean the opinion on the financial statements is also bad?
Not necessarily, no. It's possible to have ineffective internal controls but still have financial statements that are fairly presented. Maybe the auditors did extra testing, for instance.
Ah, okay.
But the auditor must carefully consider the impact. They have to state in their report whether the adverse opinion on internal control affected their opinion on the financial statements. It's an assessment they must make and disclose.
Okay, let's pivot to a few other complex reporting situations auditors might run into. What happens if the auditor faces a scope limitation? What does that mean?
The scope limitation basically means the auditor couldn't do everything they needed to do. They were restricted somehow. Maybe they couldn't get access to certain records or observe a key process or get confirmations.
So they couldn't gather enough evidence.
Exactly. And that's extremely serious because without sufficient appropriate evidence, the auditor simply cannot form an opinion.
So what's the consequence if they're blocked like that?
The auditor really only has two options. Withdraw from the engagement altogether, if that's possible and practical. Or they must issue a disclaimer of opinion. A disclaimer isn't an opinion at all. It's the auditor formally stating they cannot express an opinion because they couldn't get the necessary evidence.
So they're saying, we can't tell you if it's okay or not.
Precisely. It's like saying, we were hired to audit, but we were prevented from doing the full job, so we offer no conclusion.
How does the report change to reflect that? It must look quite different.
Oh, very different. There are specific, significant modifications. The introductory paragraph changes. Instead of saying, we have audited, it says, we were engaged to audit.
Subtle but important.
Yes. And the final sentence stating an opinion is omitted. The auditor's responsibility section is also heavily modified to state clearly that because of the scope limitation, they were not able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion.
And they have to explain why they're disclaiming.
Yes, there's a separate section added, usually titled Basis for Disclaimer of Opinion, which describes the substantive reasons what exactly prevented them from getting the evidence.
And they have to be careful not to sound like they did some work, right?
Very careful. The auditor should not include language that might undermine or overshadow the disclaimer. For example, listing procedures they did manage to perform could be misleading in this context.
Even with a disclaimer, if they happen to find a material weakness before the scope limit hit, do they still mention it?
Yes. Any material weaknesses identified must still be described in the report, usually within that basis for disclaimer section. The definition of a material weakness is also typically included.
And communication.
Management and those charged with governance must be informed in writing about the scope limitation leading to the disclaimer. That's non-negotiable.
Okay. What about big companies, global operations, where maybe multiple audit firms are involved? You hear terms like component auditor or other auditor.
Right. That's common in large, complex audits. You'll have a primary auditor, sometimes called the group engagement partner, who takes overall responsibility, but they might rely on the work of component auditors who audit specific subsidiaries or locations.
How does that affect the reporting on internal control?
Well, the group auditor has to decide whether to take responsibility for the component auditor's work or to reference them in the main audit report. What's really interesting here, based on our sources, is that the decision to reference another auditor in the internal control report is made independently from the decision for the financial statement audit report.
Really? So they could reference them for the financials but not for the controls, or vice versa?
Exactly. The group auditor makes a separate judgment call for each report based on various factors. They might feel comfortable relying on the component auditor's ICFR work without mentioning them, even if they do reference them for the financial statement portion, or the other way around.
Fascinating. Okay, let's talk about timing issues. Subsequent events. What are those in the context of an integrated audit?
Subsequent events are basically significant changes related to internal control that happen after the main audit period ends. That's the as of date, usually the balance sheet date,
Yeah.
but before the auditor actually issues their report.
So in that window between the end of the year and when the report comes out.
Exactly. And auditors have specific responsibilities regarding this period.
What do they need to do?
They need to actively inquire of management about any such changes. They need to get written representations from management confirming what happened or didn't happen, and they should examine relevant documents or evidence related to that subsequent period.
Okay, so what if they find something? Does it matter when the condition existed?
Yes, the timing is key. If the information they discover relates to a condition that already existed at the as of date,
Like they find out a control was broken all along.
right, then they need to take appropriate action based on that. If it reveals a material weakness existed at year end, they'd issue an adverse opinion reflecting that past reality.
And what if the condition only arose after the as of date, like a new problem popped up in January?
If the condition arose entirely after the as of date, then that information should be included, but usually in an explanatory paragraph within the auditor's report. It doesn't change the opinion on controls as of year end, but it provides important context for the reader about subsequent developments.
Clarity is key. Does the auditor have to keep checking things after the report is issued? Keep monitoring?
Generally, no. Once the report is issued, the auditor typically has no obligation to make further inquiries or keep tabs on the company's controls. But if they do become aware, after the report date, of a condition that existed back at the report date, and if they had known about it then, it would have changed their report.
Then they have to do something.
Yes, then they must take appropriate action. That could involve discussing with management, potentially withdrawing the original report, issuing a revised report, or notifying regulatory agencies. Depending on the circumstances, it's about correcting the public record.
Okay, one last scenario from our sources. This one sounds interesting. A voluntary engagement where an auditor reports specifically on whether a previously reported internal control weakness has been fixed. Why would a company do this?
Yeah, this is a fascinating one. Companies do this voluntarily. It's not required usually to demonstrate improvement and rebuild confidence.
So they had a material weakness, got an adverse opinion, fixed it, and now they want the auditor to confirm the fix.
Exactly. It's a way to publicly signal to investors, lenders, and other stakeholders that the problem identified earlier has been successfully remediated. It shows concrete action and improvement. And because it's voluntary, they can choose to do it any time after the fix is in place.
What's the auditor's objective in this very specific kind of job? Are they re-auditing everything?
No, not at all. The objective is very narrow and focused. It's to provide an opinion only on whether that specific previously reported material weakness still exists or if it has been eliminated as of a certain date. They aren't giving an opinion on the overall effectiveness of ICFR.
Just on that one specific issue.
Just that one.
Are there conditions the auditor needs before they can even take on this kind of focused engagement?
Yes, there are several prerequisites. First, the auditor needs to have sufficient knowledge of the company and its overall ICFR system already. You couldn't just hire a new firm off the street easily for this.
Makes sense.
Second, management must accept responsibility for the effectiveness of ICFR. They must have evaluated the controls related to the fix, asserted that the weakness is gone, and provide the auditor with sufficient evidence and a written report detailing their assessment.
Okay.
And third, it has to be clear that the auditor's testing will be limited specifically to the controls that management claims have fixed the weakness.
So if everything checks out, how does the auditor give the company that clean bill of health on the old redness? What do they need to see?
To issue an unmodified opinion, basically saying, yes, this weakness is gone, the auditor needs sufficient evidence. Evidence about both the design effectiveness, does the new control look like it should work,
Yeah.
and the operating effectiveness, is the new control actually working consistently?
Both design and operation.
Yes. They need to confirm the previously reported weakness is truly eliminated. And critically, they need to ensure there were no scope limitations placed on their work related to testing those specific controls. If they get all that, they can issue the opinion confirming remediation.
Wow. Okay, so stepping back, what does this all really mean for us? We've definitely unpacked a lot here. The crucial layers of communication, reporting in an integrated audit.
Yeah, from those fine distinctions between control deficiencies, significant deficiencies, material weaknesses,
To the really weighty implications of finding a material weakness and getting that adverse opinion.
and even navigating those tricky scenarios like scope limitations, subsequent events, component auditors.
It really becomes clear that an auditor's report, especially on internal control, isn't just some rubber stamp.
Not at all. It's a meticulously crafted document. It's a vital communication tool that ideally underpins trust in the financial markets.
Right. It provides stakeholders with these transparent insights into a company's internal health, its processes.
It's really a testament to the rigorous standards, the professional skepticism required, and that ongoing dialogue that has to happen between auditors and the companies they examine, all aimed at building confidence.
So thinking about all this detail, all this communication, the rigorous reporting, it does make you wonder about the future. Given how much detailed work is involved, what new technologies or maybe AI advancements do you think could potentially enhance the efficiency or clarity of these audit processes? But, and this is key, without compromising that essential human judgment and skepticism that still seems so incredibly vital.